Okay. Bob, are you good?
Good.
All right. Hello, everyone, and thank you for joining us today. As a board member of the Community Foundation of the Verdugos, I want to offer everyone a warm welcome. Before we move any further, I just want to let everyone know we are recording this webinar. So you may receive a little button to click and accept the recording. The recording will be made available at the end of the webinar, okay? Additionally, you can submit questions during the presentation using the Q&A button. Should be at the bottom of your screen. And those questions will go to me as I will be moderating. And we'll leave some time at the end for answering the questions, but feel free to utilize the Q&A throughout the presentation, while the question is top of mind. The Community Foundation of the Verdugos is pleased to host this educational webinar on planned giving options, including charitable remainder trusts, also known as CRTs. Charitable remainder trusts are a great tool for helping a beloved charitable cause while also providing a benefit to the donor beneficiaries. This webinar is part of the Foundation's ongoing goal to provide helpful education as it may relate to your own estate plans or that of a loved one. The Community Foundation of the Verdugos is a nonprofit organization that helps link donors to needs in our region. It also focuses on information and education of interest and benefit to those wishing to help make a better community for all. So now I want to introduce today's speaker, Mr. Bob Birgen. Well, Robert Birgen, but his friends call him
Bob. Bob, please.
All right. Bob is a principal with Abridge Partners in Diamond Bar. He has 30+ years of experience solving tax and financial problems for his clients. He began his career as a CPA working at Ernst and is it Winnie?
Yeah, Ernst and Winnie.
From 1980 to 1987 in the downtown LA and Riverside offices. Bob was a presenter at the 2001 USC Institute on Federal Taxation on the subject of IRA Distribution Planning. His articles have been published in the Journal of Accountancy and the LA Business Journal. He's been quoted as a financial expert in the LA Times. His interview on Forbes Radio aired as part of their Business Ethics Investment Guide, and he co-authored The Complete Guide to Estate and Financial Planning in Turbulent Times in 2010. Bob serves on the steering committee for the Estate Planning Discussion Group of California Society of CPAs and is a past president of the board of the Inland Empire Estate Planning Seminar. Bob graduated magna cum laude from Cal State Poly. As he crossed the stage to receive his diploma, witnesses alleged to have heard his parents yelling, "Thank you, Lorde." He earned his Certified Investment Management Analyst designation from the Wharton School of Business. He's a licensed insurance agent and certified financial planner, holds his American Institute of CPAs Personal Financial Specialist designation. On a personal note, Bob lives in San Dimas with his wife and 4 amazing daughters. He has hiked to the bottom of the Grand Canyon 7 times, climbed to the top of Mount Whitney, this California State High Point, twice, and summited the Iowa State High Point located behind Mr. Sterler's Pig Barn twice. Without further introduction, Bob, please take it away.
Emily, thanks so much. And welcome everybody, and thank you so much for spending your valuable time to be here. I know many of you have already spent a full day at work, whether that's at home or in a traditional place of business. And if you're retired, maybe you didn't spend a day at work, but I know that I'm the only thing standing between you and dinner, whether you worked or not. So thank you so much for being here, and welcome to everybody. So because I'm the only thing standing between you and dinner, let's jump right in, and we're going to see if what worked in the rehearsal works now. So Emily, do you see 1 slide or 2?
I see 2.
Okay, all right. So I think what we need to do is kind of start the slideshow. Okay, start the slideshow after I've opened it. So let me do the screen share here.
And again, folks, the Q&A button at the bottom of the screen, that's what you'll use to ask any questions. And at the end of the presentation, we'll leave time for questions, and you'll be able to utilize the raise hand feature at that time as well if you wanted to speak and ask your question. Yep, that's what you should do. Slideshow. There you go.
One slide.
Perfect.
Awesome. All right, thanks for bearing with us, everybody. So I know I'm going to start off with three things that I know the foundation has already talked about these things, but it's just such low-hanging fruit and so easy to do these things. I think they bear repeating. So I've taken a liberty with the title, and because planned giving options, including charitable remainder trusts, boy, I was an accounting major in college, and that puts me to sleep. So I decided to wordsmith it a little bit and call it "How to Take Money Away from the IRS and Keep It in Your Hometown." So here's some ideas how to do that. I'm going to do 3 quickies, and then we're going to do a deep dive into charitable remainder trusts, as Emily said. So just in terms of planned giving is kind of any strategy that kind of uses the IRS to subsidize the gift and sometimes is tied into estate planning. So I like to start with, the easiest thing in the world, and that is to name the community foundation as the beneficiary of some of your accounts. So could be a life insurance policy, could be an IRA, 401k, or an annuity. Generally speaking, if you're married, you would name your spouse as the primary beneficiary of these instruments. And then if you wanted to leave money to the foundation, you would name the foundation as a contingent beneficiary. The reason I love this is that you don't need an attorney. All you need is the information that's on the screen. You really don't even need the taxpayer ID number. They can fill that out later, but so very easy. The IRA and 401ks especially are very, very attractive, because if your kids get that money, they're going to pay tax on it. And depending upon their tax bracket, they may only get, 40, 60 cents on the dollar, where if you name the foundation as the beneficiary, the IRS gets absolutely nothing, and 100 cents on the dollar goes to the foundation. So very, very easy peasy. The next up is the charitable IRA rollover. So those of you that have retirement accounts, IRAs, 401ks, profit sharing plans, etc., it's a really good deal, because for most of your life, you've got that money working for you and not for the government. But once you turn age 72, they say it's time to give Uncle Sam a little sugar. So you have to start taking money out at age 72. Used to be 70 and a half. Rather than do that, and they kept the old age for purposes of what's called the charitable IRA rollover, you can gift up to $100,000 per year from your IRA and go directly to the foundation. So completely bypasses your tax return. So again, really clean, goes right to the foundation, doesn't add to your 1040 math, exclusion, phase out amounts. The money never even touches your tax return. So if you're in what's called required minimum distribution status, please contact your financial advisor or the financial institution and ask them for the paperwork to do a charitable IRA rollover. Again, very easy peasy, don't need to talk to an attorney. Next up is gifts of appreciated stock. So rather than for my own charitable giving, I don't write checks to charities anymore. I make gifts of stock that is appreciated, and then buy the stock back. So let's walk through an example. So say we bought Tesla stock for $15,000. Now it's worth $65,000. If I were to sell that, I would have a $50,000 gain. And if I was in the highest tax bracket, I would pay $19,000 in taxes. Now, theoretically, I could, sell the stock and then gift the cash to the foundation. But again, when it goes into your tax return, there's all these phase out exemptions and it never ends up being a net zero as far as the tax benefit. So if instead what we do is we just gift, instead of writing a $65,000 check to the foundation, we gift $65,000 worth of stock to the foundation. And then the check that I write for $65,000 is to Schwab or whoever my financial institution is. And then I buy back that Tesla stock. But now I've got a $65,000 cost basis that I could sell it and there's zero tax. So literally what I'm doing is I'm using the government's money, if you will. The government is subsidizing my gift to the foundation. So if you're not using this strategy for your charitable giving, please contact the foundation. They can set up a donor advised fund for you, and very, very easy to do this. And again, all these strategies really involve using the government to subsidize your charitable giving. These are legal and legitimate tools, and boy, if you're not using them, you're missing out. You're paying taxes unnecessarily. Okay, so let's talk about charitable remainder trusts. So kind of the easiest way to describe what is a somewhat complex technique is to use an example, a case study. So let's pretend that you're 60 years old, you're married, your spouse is also 60, and I'm going to confess up front, I'm going to use numbers that are kind of high, and not very few people have this kind of money, but I confess that I'm just lazy and I'm picking big numbers so that way I could just use the maximum tax bracket rather than try to fiddle around with different brackets. So we'll pretend you have annual income of $1 million. We'll pretend your net worth is $40 million. The reason I picked that number is to include estate taxes in the scenario. Again, not everybody is in a position where they'll pay estate taxes or their heirs will. Lastly, let's pretend you have a business that you started 30 years ago and you want to sell that business. So first of all, what are we up against in a sale like this? So these are the tax rates that we're looking at. So pre-2026, you have what's called ordinary income. And when you add it all up, the maximum bracket is 54%. So over 50 cents on the dollar is going to the government. Capital gains tax, so stocks, things of that sort, real estate as well, the maximum rate is 37%. Then there's this funky animal called Section 1250 recaption. You're thinking to yourself, what the heck is that? Well, this would apply if we were selling real estate. So if you have real estate, could be an apartment building, a commercial building that has been depreciated to the extent that you use what's called straight line depreciation, that depreciation is recaptured. And because you got the tax deduction benefit at the ordinary income level, they don't give you the full benefit of capital gains treatment. There's this special funky 25% rate that applies. On top of that, if you use something called accelerated depreciation, some of your gain will also be subject to ordinary income rates of that 54% bracket. Okay, post 2025, when the Trump tax cuts sunset, we get a little bit of a tax cut in California because we lost the ability to deduct our state income tax against our federal taxes. So the ordinary income tax rate drops from 54% to about 51%. The capital gains rate drops from about 37% to about 32%. And then that funky Section 1250 recapture rate drops from 42% to about 37%. So that's what we're up against. I should apologize in advance for the numbers. As Emily said, I was an accounting major at Cal Poly, and I like to joke that there's three kinds of people in the world: those that are good with numbers, and those that aren't. And it's also appropriate that I observe that because of the mute function, and I can't hear anybody, I feel very comfortable because I get the exact same response when I drop a dad joke at the family dinner table, resounding silence. And here I can blame it on the mute buttons. At home, my kids just tell me, "Dad, you're just not funny." All right, so we're going to walk through this example of a business sale. So we're selling the business for $10 million. Our cost basis is $250,000. So like many businesses, you started this business in your garage with a crazy idea and a stack of bills. So it was mostly sweat equity. So you've got a big gain, $9.75 million. So what does the tax man do with that? Well, remember, we've got a 37% tax rate. Because this is not real estate, we don't have that funky recapture tax that we have to deal with, but we do have a 37% tax. So at 37%, we're going to give $3.6 million to the government. So we deduct that tax cost from our sales price, and that means we've got $6.4 million left over to live off of the rest of your life. And let's pretend that you can get 4% on an after-tax basis. That equates to about 7% pre-tax, but just to keep it simple, we'll just call it 4% after tax. So that gives you $256,000 per year to live off of without touching the principal. So the government isn't done yet. So after you and your spouse have both passed away, the government gets another bite at the apple. There's a 40% estate tax, and the government gets an additional $2.6 million in estate taxes, and your kids get $3.8 million. So out of the original 10 million, only 3.8 million is left. So let's kind of summarize. So we're going to look at it on a before and after basis. So before assuming a taxable sale, and after assuming a sale using a charitable remainder trust. So you got $256,000 per year for the rest of your life. Your kids got, at the end of the day, $3.8 million. The government got $6.2 million. So that's the $3.6 million of capital gains taxes and $2.6 million of estate taxes. So the government really likes this deal. Oftentimes, when I present this idea, people hear the word charitable and their minds automatically close, because particularly when dealing with a number this big, they say, I might be charitably inclined, but I really do not want to be charitably inclined to the tune of $10 million. But when you look at this, you can see that the government is getting most of the money. And I would argue that, I disagree. You're very charitably inclined. It's just that it's going to be a charity of the government's choice instead of a charity of your choice. So let's look at how we can be charitably inclined and keep it in your hometown. So let's talk about how a charitable remainder trust works. So I suspect that many of you have living trusts, and setting up a charitable remainder trust is not a whole lot different from setting up a living trust. You go and you meet with your estate planning attorney. You work with someone like Bob Birgen, maybe your CPA, to make sure that it has the proper bells and whistles, that the I's are dotted and the T's are crossed in such a way that it meets your objectives appropriately. You can be the trustee of the trust, and I strongly recommend that. Just about every single trust that I've done, the client has been the trustee. It's important to maintain control, of course. So when you're negotiating the sale of the asset, you're the one calling the shots. When it comes time to invest the money, you're the one calling the shots. So it's appropriate to your rate of return objectives and your risk profile. So once the trust is completed, you and your spouse sign the document. You then transfer the stock in your company to the Charitable Remainder Trust. Now it's you and your spouse as trustees of the trust. Because the trust is a tax-exempt entity, when you sell the stock, there's zero tax. So instead of living off of tax diminished principal of $6.4 million, you have $10 million of tax-free principal to live off of. So at that same 4% net after tax return, now you have $400,000 per year after tax to live off of. Now, there's no free lunch. And of course, it begs the question, why is this tax-free? Well, obviously, there's that charitable word in there somewhere. So where does that come in? So at the end of the day, after both you and your spouse have passed away, whatever's in the trust will go to the foundation, okay? Now, it's at this point of the conversation where about 30% of the people hearing this story get this very thoughtful look on their face, and then their eyes light up and they say, let me get this straight. I can save $6.2 million in taxes and disinherit my kids? It's like, oh my gosh, where do I sign up? But about 70% say, you know what, I really do hate paying taxes, but I don't hate my kids. So what can we do about that? So what we'll do in those 70% of the cases is that we'll take some of the excess cash flow from the tax savings and then make a separate gift to a new irrevocable trust. Again, when you meet with your estate planning attorney, set up this trust, very different from your living trust, very different from the charitable remainder trust. But the benefits of this trust is that it is outside of your estate for estate tax purposes. So each year you would gift $38,000 worth of cash to this trust. And then the trustee of that trust, usually it's an adult child or trusted family friend, possibly an advisor, CPA, or attorney, and the trustee buys a life insurance policy. So I don't know if you can see the lights just got turned out, but I guess I'm the last one here now. So buys a life insurance policy. And I backed into the amount of the insurance. Not coincidentally, you can see that that's the same amount that the kids would get after estate taxes. So I deliberately chose this amount. So from the kids' perspective, they're ambivalent. They don't care whether you sell this asset and pay tax or whether you sell it using the charitable remainder trust. They're going to get the same amount of money. So this way we can really hone in on and focus very precisely on what are the benefits to you. So let's recap the after. So because you do hate paying taxes, but you don't hate your kids, you're getting $362,000 per year. And that's after tax, after insurance premiums / gifts. The kids got $3.8 million from the Wealth Replacement Trust, from the life insurance. So they're ambivalent. They're the same either way. Here's the heartbreaker. The government gets a goose egg. Absolutely nothing. And the foundation got whatever's in the trust at the time that both you and your spouse have passed away, $10 million. So there we go. Not a bad day's work. Now, I've oversimplified this a little bit, and I'll show you why in just a second. So if you think conceptually about the Charitable Remainder Trust, there's two pieces to it. There's a piece you keep and a piece you give away. So the piece that you keep is the income for the rest of your life and your spouse's life, if you're married. The piece that you give away is whatever goes to the charity at the end of the day. Now, the Charitable Remainder Trust is not appropriate for everybody. So if you want the money, you should not do a Charitable Remainder Trust. Just recognize, though, that you're going to give up, up to $6.2 million to the government. So there's a price to pay to get the money. However, if you want the income from the money, the use of the money, if you will, in the right situation, you can see the Charitable Remainder Trust just becomes a no-brainer. So how does it look over time? So this is just little stacks of money versus big stacks of money. So we got the little stacks of money in red. That's the taxable sale. And you can see that, let's see, through 2025, just looking at the red, it's a certain level. And then if your eyes are really good, you can see a slight uptick in 2026. And that's when we get a little bit of a raise because as the Trump tax cuts sunset, we're going to get our state income tax deduction back, and our net tax rate is going to go down a little bit. But I know what you're thinking, Bob. Please explain what's going on in the blue. I mean, those first 4 years look kind of crazy. And this is what I describe as the icing on the cake. So the two conceptual pieces, the piece you keep and the piece that you give away. So the piece that you give away, even though the foundation isn't going to see that money, hopefully for many, many, many years, you get a charitable contribution deduction today when you fund the trust. And it's based on an actuarial calculation that is the value of that hypothetical piece of what you give away. So even though they're going to wait a long time to get it, the foundation gives you an income tax deduction now. And the way that works is there's a limitation on that. And what you don't use up in year one, you can carry forward up to an additional 5 years. So in this hypothetical scenario, We're limited in years 1, 2, and 3. And then in year 4, we use up what's left. Year 5, the deduction is completely exhausted. And then you can see there's a little bit of a downtick just in 2025, and then that little bit of an uptick in 2026 when we get the tax benefit of our state income tax deduction back. So that's how it works. So let me maybe give you a couple of stories just to put flesh on the bones here. So let's see, it was probably the mid 80s. I had a college era friend who was telling me about a new business he was starting. And this new business was based on a pipeline that went into every single home in the world, in this country certainly. And this new industry was ramping up to put every kind of good and service you can imagine into that pipeline for people to buy. And I remember looking at my friend thinking, you know, what have you been smoking this time? But of course, what he was talking about was the internet. And the company he founded was one of the very early internet startups. When the company went public in the early 90s, he sold some of his stock in the IPO via a charitable remainder trust. And it worked just like you see here, you know, zero tax. And he and his wife would get income from that the rest of their lives. Well, years later, they went through an ugly, ugly divorce. And her divorce attorney was one of those whose business model was built on fanning the flames of hatred and bitterness until all the money was gone. In which case, you know, have to settle because you can't pay my bill anymore. And they got to that point. Home was mortgaged to the hilt, the retirement plan money was gone, bank accounts decimated. But the attorney thought to herself, well, there's money in this charitable remainder trust. We can break the trust and fight some more. And I don't know if we have any attorneys on the line, but you know, you can break an irrevocable trust if everybody agrees. All my friend had to do was say no. Oh, I guess we really are out of money and we really have to settle at this point. I did not know this was all going on until a few years later, my friend told me that the only money that survived his marriage and divorce was the money in the charitable remainder trust. So it got me to think, and let me clarify something. This is not a device to divorce planning to take money away from your ex-spouse. This was a community property asset. So he continues to get 50%, she gets 50%. So it's not that type of creditor protection, if you will. But I'm very passionate that if you are going through a large realization event, maybe a sale of a large piece of real estate, a sale of the business, like the example here, at least take a slice of the pie and sell it using a charitable remainder trust. It's not an all or nothing deal. And you can set the trust up in such a way that they call it a spigot trust, so that if you don't need or want the money, you just leave the spigot closed. If down the road you do need or want the money, you just open the spigot, get the current year's income and any shortfall from prior years. But in the meantime, the money is in the trust, compounding tax-free and creditor protected. So very, very cool deal. So I would say that virtually every charitable remainder trust that I've created on behalf of my clients, it's not because they were charitably inclined, it's because of the economics, the tax savings. Some were charitably inclined, and that was just the icing on the cake, much like the charitable contribution deduction. But let me tell you a quick story about the one client that did it that was not charitably inclined. So this was an elderly couple. He was 93, mom was 89. They had 100 shares of Berkshire Hathaway stock that they were looking at selling. And the son-in-law, who was a CPA, was the one that brought me into the picture. And I was just giddy over the tax savings, because that's what just rocks my world. And the son-in-law wagged his finger at me and he said, if you talk about tax savings, you are going to lose the client. You're going to lose my father-in-law and mother-in-law, because they consider paying taxes a privilege for all the good this country has done for them. Now, this really blew my mind, because what I didn't tell you was that the business was a grocery store that was one of the largest individual grocery stores in North America. And because they were Japanese, when World War II came around, they were placed in the internment camps. And most Japanese lost everything, businesses, real estate, you name it. But in their case, there were a couple of Dutch brothers that thought that would be unconscionable. So they asked them, would you be willing to rent your store to us? And the husband thought, well, you know what? One of two things is going to happen. Either they'll kill us in the camps, in which case it doesn't matter what I do, or they won't kill us, in which case it'd be nice to have something to come back to. So they agreed to lease the store. And they did not get killed in the camps, so they did have a business to come back to. The family is of the belief that this was where the Vandere brothers, who up to that point had really just been operating grocery stores as kind of the small corner market, how they learned the supermarket business and the sign that has the word Vons on it. So anyway, they did not do it for charitable purposes. What they did it for was that the income went to their 3 children, and when we say children, they were in their 60s and 70s. But then when the children passed away, the money will go to a donor advised fund run by their grandkids. So what really excited them was knowing that many years down the road, the family money would be a cause for the grandchildren to get together once or twice a year, think great thoughts, and talk about how they're going to make the world a better place. And that's what they did. So taxes didn't have anything to do with that. So I think this is a good stopping off point. So Emily, do you want to open it up for Q&A?
Sure. We do not have too many questions in the chat, so feel free to raise your virtual hand if you prefer to ask the question, or go ahead and chat now. I'll start with the question that I have. When you set up the Charitable Remainder Trust, do you have to name a charity at the time of setting it up, or can it be TBD? How does that part work logistically?
Boy, that's a great question. And normally you do, but I have one client that did not name a charity, and they still have not named a charity. And it kind of freaks me out. Like, this is a lot of money. But their attitude is let our kids decide, you know. So the answer is no, you don't. But you, when the attorney drafts the documents, it will name. It does have to be, you know, some type of charitable organization.
Thank you.
And then maybe related to that is, I generally recommend that the donor reserves the right to change the charitable beneficiary, because let's face it, the world changes, charities change and people change. And, you know, it could be they found the cure to cancer. Or maybe the charity is moving in a direction that, you know, you don't like. Or just as an individual, maybe something has happened in your life that there's another cause that really excites you. And you want to change for those reasons. Further, it does
flexibility.
Yes, exactly. Again, we're generally talking about a lot of money. So even though it's an irrevocable trust, you can still have a tremendous amount of flexibility and control. And it doesn't have to be one charity. You can name multiple charities. Further, if you want to keep the charitable beneficiary designation private, you do not have to tell the charity. That's another misconception, is that, you know, some charity is somehow in control, if you will. They are not in control. Last year, I had 2 charitable remainder trusts mature, and there were 4 charities that got six-figure checks. I take that back. 2 got $1 million checks, and then 2 got 6-figure checks. They had no idea. They had no idea.
Okay, we have a couple of questions coming in here. The first one, how common are CRTs? Was there a trend in the past, or is there a growing trend?
That's a great question. So I'm going to say they were more prevalent in the past, but now there is a growing trend, because there were some tax cuts that significantly reduced the capital gains tax. And, you know, if you're not charitably inclined, it's really all about, you know, how much taxes are you going to pay? But, you know, when you're in a 37% capital gains bracket, that's a pretty big hit. And if it's a piece of real estate and you're adding in the recapture tax on top of that, the economics become much more compelling. So I would say, you know, they've kind of gone through a cycle that was high, dipped a little bit with some of the capital gains tax cuts, and now making a resurgence.
Great. Next question is, can you please review again the donation of stock and how, after donating it, you can buy it back?
Okay, sure. Let's see if I can go back to that slide.
Okay, you want to share your screen? I'll stop sharing.
Yeah. Okay. I think it's this one. Okay. Okay. So we have this Tesla stock. We're selling it for 65,000. We could sell it for 65,000. We paid 15,000 for it. So if we were to sell it, we would have a $50,000 gain, and paying a 37% tax on it, we would pay 19,000 in tax. So this is kind of a compare and contrast. So I could, you know, sell it for $65,000, have $65,000 in cash, and then write a check to the foundation, and I've got the $50,000 gain. I've got a $65,000 charitable contribution deduction. But the problem is, in the tax return, the minute you increase your income, which you would be doing with the $50,000 gain, there's all kinds of phase outs, deduction losses, increased tax rates that kick in. It's really complicated. But if instead what you do is you just gift the stock directly to the foundation, then you get a $65,000 deduction. There's no increase in your income because you're not recognizing that $50,000 gain. And in fact, you've never paid tax on that $50,000 gain, and you're kind of using the government's $19,000 of taxes that you're not paying, you're kind of using that to subsidize the gift. I mean, your true out-of-pocket cost is only the $15,000 that you used to buy the stock in the first place, yet your deduction is $65,000. So instead of writing a $65,000 check to the foundation, don't do that. Gift the stock to the foundation, but now you don't have the Tesla stock anymore, and maybe you think that's still a good investment. So now what you do is you write the $65,000 check to Schwab or your brokerage account, whatever it is, and then you buy back the Tesla stock at $65,000. Now, you could turn around and sell it the next day, and there would be zero gain because you've got, instead of a $15,000 cost basis, it's a $65,000 cost basis. So that $50,000 gain is gone forever, and you kind of got a fresh start, if you will. Does that help?
Camille, if that was fine, go ahead and give us a thumbs up. If you want more clarification, we can unmute you and you can ask. I think that was a pretty good explanation. We'll move on to the next question. Oh, great. She says yes.
Okay, good.
Perfect. Thank you. The next question is, are most financial planners and attorneys familiar with CRTs? If my own attorney is not, what should I do?
Oh boy, that's a heartbreaker. I've had many situations where, Emily, can you stop me sharing? I can't find the.
You bet.
Thank you. Yeah, I had many a situation where the attorney was not knowledgeable with charitable remainder trusts, and unfortunately, sometimes it's easier from their perspective to say no than to say I don't know. But if your attorney is not an expert in charitable remainder trusts, we can find attorneys that are, and attorneys that will kind of act as what's referred to as kind of a back office, if you will, act as special counsel, just to do the charitable remainder trust, so that your family attorney can maintain the relationship and not lose the business, but just get someone that's an expert in the charitable remainder trust. So great question. And unfortunately, I've seen some situations where the charitable remainder trust was just like the absolute perfect solution, but the attorney killed it just for that reason. It was easier to say no than I don't know.
It looks like that is all of the questions. Any last minute ones? At this time, Bob, thank you so much. Thank you for these tips. Thank you for the information, answering the questions. Above all, thank you for the jokes.
Oh, I got one more. I got one more.
Okay.
So puns make me numb, but math puns make me number.
See, I wish you could hear everyone. They're just roaring, laughing. Okay.
Yes. I'm gonna tell my family that, and they're gonna say, "Dad, we don't believe you."
Tell those 4 daughters of yours that you were a hit.
Awesome. Thank you. Thanks. It's a joy to be here. Believe me.
Thank you. And I'd also like to thank Edna, the Community Foundation's CEO. If anyone has any questions, please reach out to Edna, edna@cfverdugos.org. Thank you so much, Edna, for coordinating this webinar. If you have any questions, again, you can, questions establishing a donor advised fund or to make a general donation, please reach out to Edna. Again, thank you all for attending. We know how valuable your time is. We really appreciate it. Bob, thank you so much. Again, the presentation will be available and will be emailed to everyone after we close out here. So thank you so much.